My name's Ian Townsend and I'm here with John Elsigood, Wealth Relationship Partner here at Cooper Parry Wealth, to discuss all things fees and charges. So let's dive straight into it and find out, John, why should we care about costs?
Well, I think the answer to that, Ian, is twofold. Firstly, as consumers, we're typically conditioned to think that the higher something costs, the better quality it will be. So typically we see clients, new clients in particular, come to us with investment products with a level of charges, assuming that that's absolutely fine and it will translate into more investment returns. And unfortunately, the opposite is the case with investing. There are annual studies run on the performance of fund managers, and overwhelmingly the conclusions of those studies shows that in investing, the lower the investment cost, the more that will translate into investment return. So typically these studies show that for lower cost funds, what we would call index tracking funds, they outperform higher charging investment funds which employ fund managers to carry out active management decisions around market timing, stock picking, forecasting, all that sort of thing. Secondly, the other part to it is what I would call the eighth wonder of the world, which is compound interest. Let's give an example. If you think about this in investment returns, if you've got a high cost fund and a low cost fund, the high cost fund charges you 2% per annum and the low cost fund charges you 1% per annum, but they're both targeting a return of 6% on average per annum. So you've got one net of charges, the low cost fund targeting to achieve 5% per annum, and a higher cost fund that's going to deliver you 4% per annum. And then we apply that to an investment portfolio, say of £1 million, and then we look at projecting those values over a typical time span for a long-term investor, 25, 30 years. The difference in value could be as much as over £1 million. So you tell me, which fund would you invest in?
Yeah, absolutely, and that could make a big difference for some of our clients.
Make a big difference for everybody.
Yeah. So given costs are so important to investors, what are the main challenges facing people out there who are actually making these decisions?
Yeah, that's a good question to ask, Ian. And unfortunately, the fund management industry, the wider wealth management industry, doesn't help investors assess the true level of costs within a portfolio. There are some costs which are easily identifiable, so things like annual management charges on investment portfolios, something called the ongoing charge for investment funds. But also there are other hidden layers of costs within portfolios with investment funds. So for instance, that could be where a fund manager is buying and selling stocks and shares. There could be stamp duty involved in that. There could be bid offer spreads, commissions. There's even things called market impact costs, where a fund manager's trying to buy or sell a large amount of a particular stock, and therefore they're moving the price of that stock as they do so. All that needs to be assessed, and all that is a cost that's borne within an investment portfolio, investment funds, and it's paid for from the investment portfolios, the investment funds. It's therefore an indirect cost to the investor, and yet it's not fully disclosed within any investment literature. It's something which the FCA recognise, and it's something which they've been working with the industry to come to a common methodology to help investors understand, but they're still not there yet. There are also other hidden costs to assess as well. Sometimes people won't think of these as costs as well. So for instance, there's the cost of doing nothing. As an investor, you look at the world and think, crikey, it's a risky place, I'm not going to do anything. I'll just keep my funds in the bank and invest in cash. But that's also going to cost you doing nothing. Cash earns a rate of return typically below inflation over time. 3% per annum inflation over 25 years will halve the real value of your cash in the bank. So the cost of doing nothing could be bigger than perhaps actually making investment decisions. There could be costs incurred around getting your tax structuring advice wrong at outset. We do unfortunately see that. Sometimes tax structures need to be undone, or you have to make a compromise and incur tax costs even though you might not want to. And there could be other costs, and unfortunately these tend to be the biggest costs, which are incurred by humans themselves not being terribly well wired to be good long-term investors. We're not good at being patient, we're not good at being disciplined with investment decisions. So we typically do things like, we see the stock market go up and we all think, oh yeah, great, let's have a bit of that. And when the stock market goes down, we all sell. So we buy high, we sell low. And those behavioural decisions, which tend to be made based on the emotions rather than logic, tend to create additional costs within portfolios, which also need to be taken into account.
Makes sense. So it's a complicated picture, lots to consider,
Absolutely.
lots to think about for investors.
Yeah.
So we had new regulations come into force in 2012, which I think a lot of people hoped would clear up a lot of these issues, but that doesn't seem to be the case. Why do you think that might be?
Well, undoubtedly the regulations are moving in the right direction, and the industry has come an awful long way from when I first started in the 80s. So in 2012 there were some regulations which came in which forced the advisors, the fund managers, to disclose a greater level of cost and greater transparency. And further legislation came in January 2018 as well, which again upped the ante in terms of cost disclosure. The issues come back to some of the technical problems around some of the cost disclosure and getting an agreed common methodology within the fund management industry, agreed with the regulator. That's an ongoing debate. There's still further to go, but at least the industry is moving in the right direction. Having said that, the investment industry is still a crazy place. Think about it, you are going to invest in a pension or investment. This has to be the only product that you could possibly buy where you still don't know to this day the full level of cost that you're going to incur. Put that another way, if you were to walk into a furniture store at the weekend and buy, say, a three-piece suite, say the cost is £10,000, and the store also said to you, plus there's going to be an annual cost, but we can't disclose the full amount of cost for that, but we'll just send you the bill in the future, you'd never sign up to it. And yet that's where we are currently with the investment industry.
Yeah, absolutely bonkers, especially for one of the most important investments of your life, right?
Absolutely.
So in your experience, do you tend to find that clients and prospective clients focus heavily on fees, or are they more focused on performance?
Yeah, unfortunately, despite the investment industry being regulated, first regulated as far back as the 80s, when they started to bring in risk warnings, which said things like past performance is no guide to future performance, we still see new clients, other investors focusing far too much upon past performance as the key decision in terms of choosing their future fund manager. And yet all of the academic studies written over the last 30 plus years amply show that there is no correlation between past performance translating into future performance and future returns for investors. And yet people still give it far too much weight.
Yeah, and that presumably comes down to the disclosure as well. If they're just seeing performance figures and not seeing costs, that's what they're going to work
Yeah,
with.
part of it is, some of it is around disclosures, some of it is around press headlines, some of it is around the fund management industry, perhaps not benchmarking their funds as well as clearly as they should do. It all masks a investor's true decisions, which is firstly to think about why are they investing at all, what are they aiming to achieve, what's the level of risk and return they need to achieve. Certainly what costs they're going to incur to do that. And most importantly, and this should be their first consideration, how does this fit into their financial planning in the first place?
Yeah, so a deeper level of understanding as to why you're doing it in the first place.
Yeah, absolutely.
So bearing in mind the importance of costs to an investor, how would you quantify the value of advice?
Yeah, that's a tricky question to answer, Ian. Value means different things to different people, so ultimately it depends on what the client is looking for and aiming to achieve. Some clients inevitably can be more investment focused, so it's about helping them understand, working with them around portfolio construction and educating them around what will really work within an investment portfolio to give them the best chances of success to achieve their investment returns for a level of risk that they're prepared to take, taking into account that there are no guarantees on any of this stuff. We don't know what's going to happen in the future any better than anybody else. But we can help clients, we can educate them, and we can help them manage their emotions and how they take decisions around that investment portfolio in the future. For some clients, it's less about the investment portfolio and it's more about how do we help them manage their wider financial affairs. And the investment piece is part of that, an important part of that, but it is just one part of that. So it's about what are they really trying to achieve, bearing in mind that few people think about their finances and their future lives just purely in finance terms. It's about life goals. What do you want to be doing in the future? When do you want to retire? Then we translate it into pounds and pence perhaps. So it's about helping them understand what they're trying to achieve from a life perspective as well as a money perspective. Get the tax structure in right so we can help clients structure portfolios efficiently, save tax in the right places. And also the behavioural coaching bit again, which is helping them make the right decisions at the right time. Ultimately, and this is down for our clients to judge, not us, that's about creating peace of mind, acting as a sounding board to make future financial decisions. I'd also like to think that we take away the worry for a lot of clients about having to actually think about some of this stuff on a day-to-day basis. What clients get in return is that they can focus on their lives. They can focus on spending the time doing the things that they really want to do. Time with the family, time doing the hobbies, they can focus on the careers. That's the important stuff.
So if you're in the position where you had to invest, and I'm sure you are, what would you do?
Well, let's not overcomplicate things for a start. In investing, I think it's fair to say that simple is good. But let's take the investing bit to one side and let's get the basics right. What am I trying to achieve? Let's try and understand that. And as part of the investment process then, thinking about the investment return I need and the level of risk I'm prepared to take. Once I've done that, it's about that word diversification. It's your only free lunch in investing. Diversify, diversify, diversify throughout your portfolio. Forget fund managers outperforming markets. All of the data shows that overwhelmingly on a long-term basis, the vast majority of fund managers trying to outperform markets don't. Let markets do the heavy lifting for you. Capture market returns in a low-cost manner using, say, index tracking funds, and let that do the work for you. Keep your portfolio on track over time, otherwise it will move out of kilter, and do something which we call is an annual rebalance, so it keeps its risk profile over time. But overall, in investing, simple is good. Or another way to put it, if your portfolio looks as dull as dishwater, that's actually a good thing.
Thanks very much for your time today, John. Some really insightful answers, and I hope you all found it really useful.